So I've been in the crypto market since 2013. So I've seen it up and down. What you need to do is focus on the big picture. Where is this going? Because what you've got is an exponential adoption of an asset class with an exponential price over time. But everything that's exponential is volatile in nature as well. Just look at the Amazon share price since it IPO'd back in '99, went down 96%, then up, then down, until you get network adoption and the network becomes mature. So if you extrapolate the rate of change of the adoption of Web3, it's the fastest adoption of any technology ever in all human history. It's about twice the speed of the internet, which is why none of us sleep anymore, because it's just relentlessly fast, right? It's crazy how fast this is.
Raoul, in his most recent interview, reacts to the sharp dip in markets and also gives advice to investors what they should do amongst all this volatility. Markets dip sharply because of the Federal Reserve indicating they have no intention to stop the raising of interest rates until the back of inflation is well and truly broken. In this video, Raoul lays out his most recent prediction and lays out why you need to be looking at long-term adoption as opposed to all the short-term noise. Make sure to stick around to the end of the video where I'll break down Raoul's prediction. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
To extrapolate out the 300 million global users now, assuming that network adoption rates slow down over time, because you can't, the earlier phase is the most exponential, we still get to 3 billion users in like 5 years. So, okay, once you know that, and let's say we're wrong. Let's say we're wrong by 75%. It's still a billion users. So therefore, don't focus on price. The future price will take care of yourself. If you're focusing on price in building your business now, you're building a weak business. You need to factor in the ability to take these very volatile swings as part of your business model. If you don't, you're going to fail. So this is a really good time for people to be building and focusing on the future and not the present. We have to distance ourselves. I do this. We do it with our investments, right? I'm in it for the long term. I don't even trade my positions. But I still have an hourly chart on my screen next to me, but I distance myself from my hourly chart, right? I don't look at my positions and figure out how much I'm up or down every day. I just don't care. But I'm very interested in what the market does. But so you have to, particularly as a founder, is distance yourself from the noise and focus on the big prize. That's why you're building a business. You're not building a business because you want to make money in the next 18 months because crypto goes up. You want the opportunity of the big prize, which is building something big and important, because this is the only opportunity that I've seen where you can build a business that goes from nothing to $10 billion in a year. So keep your eye on that. And imagine what that business could be worth in 10 years' time. So focus on the big picture. I think the move towards internet communities that are coalesce around commonality of mission and purpose, whether that's a cryptocurrency like Bitcoin, which has this very kind of digital sovereign state element to it, or whether it's around a Web3 community or an NFT community, I think is the most powerful business model unlock that we've seen since the start of the internet. And it might even be bigger than that. Because what you're doing is, if you think of the model of Facebook, Facebook is a network effects business. It's a community business, but the incentives are split. So we all as users of Facebook, WhatsApp, Instagram get the features of the product, but we don't participate in the network, i.e. we don't make any money from it. Yeah, we can build businesses on it, which is why it's a very valuable network. The shareholders took all of the value. Now, Web3 puts essentially the network users and the network owners as the same people, because you own a part of the token. That is incredibly powerful as an incentive system. So if you go back to Facebook, imagine when Facebook started, they gave shares to everybody who used it. Yes. What would you do? You would go and tell everybody. because the more people who use it, the better it is, because there's a bigger, deeper community, and the more valuable it becomes. That is the power of Web3. So it's going to hypercharge businesses and see acceleration of businesses on a scale we've never seen before. We've already seen some of the fastest growing startups in all history coming out of Web3, whether it's Binance. Binance went to 2,500 people. This is not a manufacturing business. It went to 2,500 people in 2 years from launch. I mean, it's staggering the speed that these companies are growing. Even Yuga Labs and the Bored Ape Yacht Club community, that whole thing was the fastest accumulation of wealth in any company in history. It went from zero to about $7 or $8 billion in a year. It's incredible. So I'm 100% of my liquid net worth in this, but I have income. I have property. I have, shares in Real Vision, a whole bunch of stuff, right? So even if my crypto goes to zero, it doesn't really change my life. It will be miserable, but it doesn't change my life. If you are young and you're trying to build a future for yourself, then look, I think crypto is one of the biggest opportunities we will ever be given. So you should be reasonably aggressive in it. I mean, I'd be more aggressive than others are. So if you've got an investment portfolio and you're young, I'd suggest if you're dollar cost averaging in, you're not trading it, you just want to build wealth in this asset class that grows over time, then being, 20, 25% of your savings or investments in crypto is fine. You can have some in the Indian stock market, some in bonds, some in diversified global stuff, and you're pretty much going to set up for great success. Now, if you're 60 years old, I wouldn't say the same thing. Because it's an element of risk and time horizon. Crypto's a long time horizon, because we're talking about 10 years here, where we think the big bulk of the returns is going to come in 10 years. So that doesn't really help somebody who's 60 years old, because what they're thinking about is my retirement. So in which case I would have a different discussion with them and say, sure, have some of it, because it's great, because it'll offset, the rupee, it'll offset other things. So maybe you can think about 5%. So even if it falls 50% again from here, what are you going to lose? 2.5% of your portfolio? Nobody cares.
Right.
But if it goes up 20x or something, well, okay, that becomes a lot of money. And every crypto cycle, it goes up 20x, 10x, 30x, 100x. So, think of it in those terms. This is something that most people misunderstand. There is zero correlation between the equity market and the crypto market over a larger period of time. Put up the chart of Bitcoin and put it against the S&P 500, the Sensex, anything, over 5 years, 10 years, right? There's zero correlation. One is exponential and the other is not. So what you're picking up is the periods when crypto and traditional assets are overwhelmed by the macro, which is to the earlier part of your question. So what is happening on a macro level that is affecting all asset prices in the shorter term? Liquidity is coming out. So what's that saying is the central banks are pulling money out of the markets. So obviously asset prices fall. So we are seeing that moment. It's like we saw it in March 2020 when everything fell, including crypto at the same time. But then crypto massively decoupled. Sure, the NASDAQ went up and the Sensex went up, but crypto exploded. So the correlation is only in the shorter term. The other thing is there is more correlation with the growth end of the technology market. And the growth end of the technology market, because it doesn't have cash flows, is driven by inflation growth expectations. So as inflation rises, it gets marked down because your future cash flow is worth less. So once we return to a more normal point where inflation is more stable, that disappears as a factor. So then everything gets judged on its own merits. So there are periods in time when macro matters more than everything else. Macro is how the world economy works. It's how money comes in and out. And crypto's not separate. People in the crypto market thought they were some amazing unicorn that never gets affected by global macro until they got hit by global macro hard. And they're like, oh yeah, it does all matter. I need to understand how currencies work and how money works and how liquidity works and what central banks do, because it matters. But over time, there's no correlation.
So there's Raoul Pal on the importance of sticking to your long-term investment thesis and not getting caught up in all the short-term noise and volatility. If you do ever get worried or nervous about your crypto positions, which it's easy to do, just remember these two core features. Crypto is the fastest rate of adopted technology humanity has ever seen, and exponential assets have volatile price action. For an example of this, the Amazon stock in its early days or early price action of tech stocks are a great place to look. Anyway guys, hope you all enjoyed today's video and that did provide you with some value. I'll see you all in the next video, and as always, all the best.